The Fama-French three-factor model demonstrated that value quality stocks and small mid-sized stocks have historically provided above average returns over time. But how do other factors such as liquidity, quality, and low volatility impact risk return? Hello, I'm Michael Mell, Senior Director of Custom Indices at S&P Dow Jones Indices. Joining me to examine a systemic custom approach to factors is Justin Lowry, President and Chief Investment Officer at Global Beta Advisors. Hey, Justin.
Hi, Mike. Thanks for having me.
Thank you for coming today. We really appreciate it. To get things started, I'd like to ask you to describe Global Beta to our viewers. Who are you and how do your custom indices fit with your firm's philosophy and objectives?
Thanks, Michael. Well, the key for Global Beta is our mission is simple. We want to provide targeted investment-based strategies that consider valuations, and valuations in particular by price to sales. So our research has shown that there's a nearly 90% correlation between the price to sales multiple of the S&P 500 index and its forward 10-year looking return. And so we wanted to build our factor-based strategies around that principle. And so we look at factors in a variety of different ways. We look at momentum, we look at growth, we look at quality, we look at volatility, we look at size, and we look at yield. And we want to create exposure for all of those factors, but doing it in a way that considers valuation. And so this stems back from our time at revenue shares. And when we sold revenue shares in 2015, we started Global Beta in 2016. And we really began our research around factor-based strategies in 2017 in conjunction with S&P. And so for us, we wanted to take the principle of what we did with revenue shares, which was build broad-based indexes considering valuations, and we wanted to apply it to building factor-based indexes under the same principle. And so what we've done here is we've built a multitude of different factor-based strategies that consider that price to sales valuation. So our overarching investment thesis is to help investment professionals gain access, measure, and assess different market factors at better relative valuations than their categorical peer group. So we built these factor-based strategies to help investment professionals achieve that goal.
Great. So, you know what? Let's jump into the custom hybrid indices. I understand the idea behind the index design is to track more complete exposure to the beta of equity markets at lower valuation. You were kind of touching on this, but can you get a little bit more specific exactly how this works within your custom hybrid indices?
Yeah, so let's take one of our indices, for example. So we have the Global Beta Smart Income Index, which is basically our yield factor index. And so what that is we look at yield in the prism of two different angles. It's either very high yield type of stocks, and then there's your dividend, sustainable growing dividend stocks. And we feel that the index that we've crafted here splits the difference. We want to give investment professionals exposure to the yield, but we want to do it in a way where it's sustainable and has a level of quality to it. And so when we craft our Global Beta Smart Income Index, we do it on a diversified basis. So we're trying to pull companies from every industry and every sector and be able to craft an index that has balanced exposure. Because one of the potential pitfalls of yield-oriented strategies is that you typically may see concentration in a particular sector or industry. So when we design the Global Beta Smart Income Index, we also want to weight it by fundamental, because we believe weighting it by fundamental allows us to have a basket of securities that has that improved valuation or reduces that valuation risk that we believe may exist in certain strategies that may be overrun. And speaking of risk mitigation, I want to also talk about our Global Beta Low Beta Index, which is our kind of index play on low volatility. So the Global Beta Low Beta Index looks at an index of securities by beta, but it weights it by revenue. Again, The low beta screen allows for low systemic portfolio of low systemic risk, but the weighting by revenue allows us to reduce the valuation risk. And so when I talk about valuation risk in the scope of low volatility, I think it's important to point out that the S&P 500 low volatility index has actually seen their price to sales multiple increase by about 50% from May 31st, 2011 up until before the global health pandemic bear market in February 28th, 2020. And so we believe that led to the S&P 500 low volatility index underperforming the S&P 500 index by about 260 basis points between the bear market, which is defined by the S&P 500 hitting its all-time high on February 18th of 2020 and hitting its low on March 23rd of 2020. And despite the fact that the S&P 500 low volatility index continued to underperform the S&P 500 index from February of 2020 all the way through May 31st, 2021, the S&P 500 low volatility index still had a price to sales multiple that was higher than the S&P 500 index.
Okay, that actually leads into my next question quite nicely. Why did you decide to base your custom indices off the S&P 500 and the S&P 900? And basically, our indexes are the underlying components to your indices. So why do it that way?
So we believe that S&P Dow Jones is a best-in-class index provider. And so we always like to say that we want to start with a circle of champions. And we believe that S&P Dow Jones, through their rigor and their process, allows us to have a starting universe that has a higher level of quality and a higher level of liquidity. Because it's important when you provide investment solutions to provide a level of quality and almost more importantly, a level of liquidity. So when we build our global beta low beta index, that's derived from your S&P 500 index, and the S&P 500 index is a basket of large cap securities, and large cap securities generally provide a more stable base. If you're looking for more risk off, you're going to be looking more in the large cap space. So that's why we use the S&P 500 as our starting universe for the low beta index. Now, for the global beta smart income index, we want to start with the S&P 900 index, which is a composite between the S&P 500, which is the large cap securities, and the S&P 400, which is the mid cap securities. And our research found that just as many mid cap securities pay high dividends as large cap securities. And the FAMA French research will tell you that small cap securities tend to outperform large cap securities over time. So we want to be able to create an index that allows investors to gain yield and also to gain access to smaller cap securities that have the potential to provide total return. And also, smaller cap securities, based on our research, generally provide better relative valuations than the market. And so, coupled with the revenue weight component that I described earlier in the Smart Income Index, the introduction of the mid cap securities also allows for a reduction in valuation.
Great, thanks. So, Justin, I'd like to conclude by exploring your custom approach to factors. Specifically, how do you define price to sales, and why does Global Beta believe it's so important?
So we view factors differently than traditional managers. So the traditional off the shelf factor index is not what we're proposing or what we're considering in this equation here. We have our views versus different investment professionals, but our overarching goal is to build targeted factor exposure, each factor exposure differently because each factor reacts differently in each market. But we want to make sure that valuation is considered in each factor. And that is inclusive to whatever factor that you're considering. So we define price to sales as the company's market capitalization divided by its 12-month trailing sales. And so the key component in that metric is the denominator, sales. We believe sales is the lifeblood of the company. It determines whether or not there's an economic need that the company is satisfying. So a lot of investment managers may be looking at earnings, may be looking at cash flow, may even be looking at book value. But none of that exists without the lifeblood of a company, which is revenue. So that's why we look at valuation through the prism of price to sales. And so what our research is really rooted on the fact that we built the regression analysis around the S&P 500's price to sales multiple and its 10-year forward-looking return. And as I mentioned earlier, there's a 90% correlation between whether its price to sales was lower and versus its 10-year forward-looking return. And so we believe that research is so powerful. And when investors are looking for long-term investment solutions, it is critical to consider valuations when you're investing in factor-based index solutions.
Got it. Valuations and sales, of course. So appreciate that. So thanks for your insights today.
Thanks for having me, Mike.
To learn more about custom indexing, visit us at the link below.